time he's on the screen, my producer insists that there are normally 3 bulls when Samir Nikunj and the backdrop, which is always bullish. Where is the bull today, sir? There are only 2 bulls on the
There it
screen.
is. You can see the red bull here.
Yes. There have to
Oh,
be
sorry,
3 bulls when all 3 of us meet. You, me, and the backdrop, the bull.
correct.
You
Good
were
to see you.
slightly tentative when we spoke last time. Your view was that you're not bearish, but the macro factors were far too dynamic for anybody to come up with a conclusive market view. But that was about a month ago. A lot has changed on the right side for us in last 1 month. Commodity, oil, monsoon. Are you constructive now about the market?
Yes, we have changed also quite a bit, so that if you see in the fund, the long only that Dinshaw manages, we had about 12% cash. Now I think we have 4-5% cash there. And in my long short fund, where we were, I don't know exactly what we were then, but now we are about 65% net, which is higher than our 17-year monthly average, which is around 62%. At the beginning of the year, not beginning, but maybe in Feb, March, we had gone down to around 40% or 40 something percent net in our long short fund. And even in the long only fund, we had around 15 odd percent cash. So clearly, there is a change not only in the sentiment, but actual portfolio, yes,
Because
since
of
about end of June.
Is it because of decline in commodity prices which are looking interesting, or you think prices have become attractive and you are a buyer irrespective of commodity prices?
No, prices have not become that interesting. It is because of a macro thing. So my view before was that the US market will, that we should wait for the US market to play itself out. And my thinking was that over the next 2 or 3 months, or the current 2-3 months, that either the US market will fall another 10 odd percent, or it would behave with dignity and negotiate these high inflation and this continuous sort of pressure from the Federal Reserve. But when the commodity prices fell a lot, and when oil had not fallen at that time, but commodity prices had fallen, and secondly, the US companies had guided or had poor results because of excess inventory, because they had ordered extra. And then the semiconductor guy said that they have now no shortage, and not only that, that they can see a slowing demand in mobile phones and laptops, and then the interest rates were causing pressure to the US mortgage market and the housing starts and lumber prices. So what it meant was that even though inflation number will be high, because everybody can see that a large part of the inputs into that formula to calculate inflation are falling, that plus minus 2 months, depending on inventories and depending on other stuff, that it would feed through into the actual numbers. And from an India point of view, so I just accelerated that, said even the US market is not going to fall even with the bad numbers. And actually, in our US fund, where we had some 40 odd percent cash, now we have some 30 odd percent cash. So we invested 8-10% there also.
So what is it that you bought, Samir Arora? Because the last time we spoke, you had added HDFC banks, little bit of consumer discretionary companies. Anything other than
Same,
that?
same. So we have bought on Friday one tech company, but otherwise we have broadly bought the financials and consumer. The thing with financials is that at least in my long short fund, we were like market weight, and I felt that the interface. What is the problem right now? The problem in the world is not so much what is happening in India, but what is happening in the US. And therefore, why should I go and deliberately buy something which is at the interaction between India and US, which is the IT sector? And even though the currency has depreciated, which is a big help, but if you look at, if you say to anybody, not just me, what is the biggest risk in the market or markets in general? It is that the currencies have gone haywire across the world, and that is not an easy thing to negotiate, in the sense it doesn't look like this is equilibrium, that euro is down some god knows whatever 13-14%, pound is down, Chinese are down, yuan is down, rupee is down, yen is down, and these things don't happen generally without a crisis, because everybody seems to be running to the US. Although we today feel, oh, we know why it is, because they are going to increase their rates, and it'll be very good for everybody to have have dollar bonds or whatever. Just to tell you, some Indian bonds of companies which I am 100% sure that nothing will happen to them, and who have a maturity of less than 9-12 months, you can get 9% in dollars, which is crazy.
Samir, I'm quite intrigued. What made you buy IT? The fact that they've fallen a lot? And I mean, is this in your short portfolio or long portfolio that you've picked up
No, no,
IT?
no, no. We were not short. Unfortunately, we were not short IT even when it was falling. We had just reduced it in the longs in Jan, one or two stocks. But just because, because overall we are becoming bullish. And in some sense, if we can buy US stocks, because we bought US IT stocks, you can call, or NASDAQ stocks, then although I still feel that, who knows what will happen, because ultimately I have full experience that the Indian company managements don't know anything about what will happen after one quarter, because I saw that in 2000, that they can see one quarter and the rest for them is as macro as it is macro for me. But I thought that if we can buy it in our global funds, we are buying US companies which are down. Actually, they are those stocks that are down maybe 50-60%, like Spotify and Netflix and Airbnb and all those we bought. But here we bought one stock, 1.5%, just to also keep a balance, and to, we agree that there is a sentiment versus the numbers. And so we have to control this, and we say we like the company. Why are we not buying? Because we are worried about the US, but otherwise it is looking good. So we just buy it, because otherwise it is in our well-liked list, if we call it that.
Good morning. So you've started deploying a lot of your cash, as you have said, in India as well as overseas. But Samir Arora, you've told us about a tech stock that you bought on Friday, increasing exposure to the Nasdaq stocks as well. Can I ask you about banks? There is a case that maybe banks have been attractively priced, valued, and maybe will beat IT and be at the numero uno position at the
Yes,
end of
yes,
this year.
yes. We totally agree with that. In fact, if you look at my portfolio, where effectively the net has increased by around 20% in the last, say, 4-5 months, maybe 10, 12 would have gone into financials only, which basically means the banks. Yeah, so we agree. It's just that we didn't want to do 100% in that, and so we bought one IT, but it's 1.5%. Ignore that. Even if you look at the long only fund in India, out of maybe 10 or 8, 10%, depending on which period you start, you basically bought 15% in IT, and 85% has gone into financials and consumer. So I totally agree with you. Our top three holdings are all banks, and yeah, that is the safest, because it never got re-rated a lot, and it is very good in itself, and it has taken the brunt of the FII selling. And one more big picture view that I have is that plus minus 6 months, the FIIs will be back in full force, or in some force, or at least they'll stop selling, simply because the default situation for the FIIs to buy in India and other markets, because every year these endowments and these sovereign funds and everybody gets additional money, whether it's pension fund money or whatever money they are managing. And secondly, simply we can look at the last 25 years of flows into India, and you'll find that only rarely do they sell. I think they've sold in 4 calendar years. And this year selling, at least we don't feel that it is directly related to something that the Indian system has done to them, and therefore they are deeply upset with us. It seems more to do with US rate hikes and the fact that the basket in which India is, maybe let's say a China, India, emerging market basket, or some Asian basket, is not doing well. And so, because they had to sell somewhere, the portfolio NAVs got hit, or they took profit here. But the default situation in general for all these guys is to buy. Plus, they have been buying, at least till last year, even massive amounts of private equity and venture funding and all that, which is effectively done by the same end investor. It is the same endowment, maybe a different individual. So, like, we get public market monies, but somebody else gets private equity money or whatever. The end investor has not switched off from India. So, if that comes, in some sense, the the stocks that they normally like should again benefit, because right now those are the stocks under pressure, which is mostly the banks and also a little bit of tech.
That's right, we've seen $6.5 billion sell-off and FIs, a lot of that in the financial space. That was, of course, in June. But Samir Arora, we're seeing leadership also come to the auto stocks. It's a 10% weightage on the index. Are you an auto bull?
No, I'm not an auto bull, because one of my thumb rules in life is to look at what is happening in other markets and basically connect it to India plus minus a few months. The same trends happen all over the world. So if you look at the stories for why auto is positive, but we are not short the stocks, but we don't have many longs, is that that there was these big demand and there were waiting lists of 6 months, and the only problem in the world was semiconductor shortage and all that stories. So if you read, that was the same story for General Motors, it was the same story for Ford, it was for everybody, that there was a supply shortage. In fact, even the Tesla, Elon Musk said that, and Tesla was viewed positively because they were able to negotiate it well. But the bottom line is the whole world had the same story. In fact, one reason for why inflation was up a lot, say 3-4 months ago in the US, one reason was that the second-hand car sales, the prices are very high for second-hand cars. And now you just look at the stock prices. So if you look year to date, calendar year to date for General Motors, the stock I think is down 45%, Ford is down 40%, Tesla is down 30%, Hyundai is down some 17-18%, Toyota is down. Why? Because if you look at it, all the stories which were created that this is to do with some pent-up demand and some supply issue, which for 1 year ago was for consumer companies in the US or maybe Indian or housing companies, all that took 6 months and then the story was over. So I think this is a 3-6 month story, and I think it's too late to buy, but I don't believe in it, because the bigger picture story is completely different. The big picture story is that the scale at which you have to invest for EVs and all, I don't think the Indian guys can do it. And you don't know who's the winner. Is it a Chinese funded company? Is it a private equity funded company? In India, we celebrate that some fellow has put in $1 billion into an EV subsidiary. But if you right now in front of me type on Google EV budget of Volkswagen, in fact, please do it and tell me what the number is. Or our viewers can do it, will be $100 billion. If you put EV budget of Daimler, which is Mercedes, it will be some $60 billion. So how do we know that our companies with $1 and $2 billion, which also they get from private equity type guys over 3 and 4 years, are going to develop an EV which will compete with all these guys? They may, but I don't buy lottery tickets.
Samir, a slightly, not to today, tomorrow, this week, next week kind of a question. Every decade gives us these outsized trends. Last decade, for example, you got a DMart, you got a Bajaj Finance. Before that, we got a HDFC Bank, we got a Kotak Bank. I don't know, and we don't know what will be that big outsize success story for this decade. But if you have to look at the ingredients which point to a great company or a great business or a great theme for next 5 to 8 years, what are you betting on? Where you would say, look, I'm happy to put 2, 3, 5% of the portfolio, but it's worth the risk.
So actually that is our model, in the sense that we also, we got Bajaj Finance and we made some 70 times. But do you think that even Sanjeev Bajaj or Rajiv Jain knew in 2010 that stock will be up so much, or in 2000 when Kotak was not even a bank, they became a bank in 2004, but we had it then. And the point is that you put down 15 bets on the table. We put down 15 bets of 2 to 3% each, which we call reasonable confidence in high return. These are stocks which you do as much detail as you would do for a 5, 6, 7% position, which is normally a big position for us. But you are confused. For example, in the last 2 years, although we don't own it today, we made some 4.5 times on Dixon. Now, how would we have thought 2, 3 years ago that suddenly Dixon is supposed to give you 4 times return. So you don't know in advance all these things. You buy 15 stocks and you don't buy very big. And basically, you have to put in nearly the same effort, but you are confused about something. Sometimes it might be that's a relatively new listing, and therefore you haven't seen them how they behave in public, or if it's a financial company, you have seen them for 5 years, but should you see them for 10 years and stuff like that? And you buy 2%. Just to tell you, in 2018, when ICICI Bank was doing quite badly, we bought ICICI Bank 2.5%. Today it's like some 7% of our fund. But we bought 2.5% in this category. So this category does not have to be completely new, unknown names. It can be rediscovery of the same names, or they can be new names. And you don't bet on any one because you don't know anything about anything beyond a point.
Is that 2.5% allocation? What are those 4.5, 5, 2.5% allocation in your portfolios right now?
So we have many stocks. And if you become our PMS investor, you will get them and you can see their names. But broadly speaking, I have given some names. Already we have Lemon Tree and we have Vedant Fashions, and recently we got Campus Shoes. Now, some people say, oh, but you keep coming on TV and saying you don't buy high PE companies. So why have you bought one or two of these? Because they seem to have high PE. So my logic generally has been that where the P's have become high only because of re-rating on the same growth rates of 10, 12, 15%, you can easily see that the growth rate is as it was, but you are making money only off re-rating change. Whereas some of these, I hope for the first 2-3 years will grow 20 to 30%, let's say. And then they will also all in the end grow 20% or below. But because you are slightly smaller, slightly newer, slightly something different, you may grow little higher. But if you're going to grow 12, 15%, that you should do that only when you are very big. But initially you should grow 20%, let's say, in earnings and everything. But there are many. We have uh, not only new names, but also, as I said, beaten up names. Where there's one bank which is down, what, 70%, I don't think it should be down 70%. So we have 2%. If you want to know the name, it's called IndusInd Bank, which everybody hates. But it's worth a 1.5, 2% type position because it might come back because it has been generally a good performer for many years. And we think that we know what the issues are. Sometimes rumors are spread again and again and again. Like that day, some case of 2012, they say, oh, there's a new case. Oh, who knows? The point is you put down 15 bets and you don't care about any one or two doing badly. None of them are going to go to zero. So you're not betting 2% going to zero. Some may underperform 10, 15%, but if 5, 6 go up a lot, it pays for everything. And the proof of the pudding is in our 20 odd year track record using this formula that you don't know anything ahead of time, that this stock will be the hero or that stock, but you broadly have used your factors to put down 15, 20 bets, and then the stats work. It's like a casino, that when you go to the casino, the gambler is the individual, or the gambler is playing effectively a rigged game where there's a small advantage to the casino, even if it's 4, 5%. But the casino wins because you're playing the game again and again, and not because you're playing one bet. In one bet, even with a slightly worse odds, the individual bettor can win, but you can't win if you play multiple times. So we want to play the game multiple times over the years and 15, 20 bets at a time. And then broadly, statistically, some of them will work because the effort putting in is the same. It is not that, oh, because I'm buying 15 stocks, just buy any 15 stocks.
My apologies. The Prime Minister is speaking. Got to just cut across what he's speaking to the press. Appreciate your time, Samir Arora.